Welcome to this week's Raising Millionaires Weekly Wealth Call. There is a lot going on in the macro markets. Let's touch on 2 points to get right out of the gate. The first one is kind of a tale of two economies when it comes to earnings season, which is when a lot of the publicly traded companies are reporting their financials for the quarter. What we're seeing is that a lot of consumer goods companies, products directly to consumer markets, so like McDonald's had a good earnings. Nestle has shown that they've been able to raise prices by 10% without a huge negative impact on their earnings. So these consumer goods companies are coming in and they're having positive reports. They're meeting their earnings potentials, and that kind of shows growth in the economy. Now, on the flip side, tech companies, some manufacturing companies, and then some retail, which are the companies that deliver products to consumer goods, are struggling a little bit. Now, why is it important for us to understand that these two dynamics are happening at the same time? Well, the Federal Reserve is trying to figure out what to do with interest rates. And should they keep raising them? Should they pause? Or should they even lower them if the economy is starting to stall? The indicators aren't clear. So for us as investors, of course, in the early process, ERLI, for our children, we continue our dollar cost averaging, our automated investing each month. For us as parents with our own investing, we've got to watch those interest rates because it's going to control our access to capital for real estate investing. It's going to control mortgage rates for our own personal properties. It's also going to increase borrowing costs for any type of funding that we're looking for our businesses. So there's not a clear path right now. You see a lot of layoffs in tech, and you see a lot of layoffs in other companies, and that makes you a little nervous about the stability of the economy. What do we do with all of this? Well, we continue our path forward. We continue to invest each month, and we continue to grow our portfolios so that we can continue to move forward. The onset of a banking crisis. Warren Buffett came out and said that there's still more turbulence ahead. Last 24 hours, we've seen a huge drop in the stock of First Republic, who's been dropping. They had a stock price of 120, they're down to $12, and that they saw a major outflow of over $100 billion in the last quarter. So a lot of these sub $250 billion regional or sub-regional banks are still seeing outflows that are having a negative effect on the stock price and are creating fears about runs. There was a recent piece on CNBC where they talked about how social media is playing into bank runs, especially Twitter. So you want to be really careful or cognizant of what's being talked about on social media as it relates to banks, either for your own deposits or your own investing in those stocks. When we look at the current markets, both for the S&P, which is a primary instrument that we use in the Raising Millionaires program, as well as mortgage rates, which are a big part of our overall investing strategy personally. So the S&P is sitting at 41 today. We're getting closer to the one-year highs of 42.98. And we are well off of the one-year lows at 35.88. The range, the one-year range going forward is pretty wide from different investment funds. So I like to look at the highs and lows. It's not going to change my ERLI investing strategies for our Raising Millionaires students, but it might dictate to me as an individual investor as we approach the all-time highs with a lot of the fears that are in the market that you have to question some of that overall stability. When it comes to investing for your kids' financial future, I saw an interesting post by an influencer on Instagram. And what she talked about was the idea of buying a rental property for your kids. She didn't talk about in what instrument, but I'm gonna wager to say it's probably some type of trust. The year that they're born and how that can be used to help secure their financial freedom in the future. This was really interesting because we typically buy real estate properties on 10-year notes Recently, with the increase in mortgage rates, most of those notes have gone out to 15 or 20 years. But if you think about buying a property for your child with the year that they're born and looking at it from two different price points. No, price points is wrong. Let's talk about financial outcomes. The first one is can you pay that house off in 18 years so that that house could be a cornerstone of an education fund? The answer to that question is yes. If you do a 15, even a 20-year note, you have a very high probability of paying that property off. So let's say you buy a property. I like to look in the Midwest where you can still buy single family homes or even duplexes in that $150,000 to $200,000 range. And if you look at the average increase of real estate values over a 20-year period, you're probably going to see a 50 to 100% return on that value. So that means, let's say we buy it for 150, it could be worth 300. It could pay for your kid's entire education if you were to sell that house, depending on what the capital gains rules are at that time. But forecasting what they are now, if you hold for over 5 years, you could be in a great position. What's really great about this strategy is the idea then that you buy the property, you get a renter, that you're 20% down, let's say $30,000. Could you fund your kid's entire college education for $30,000 now and put it into a piece of real estate that will then be paid off, and then the money that comes in after that compounds into other investment opportunities? It's a pretty amazing strategy. It's something that I'm going to look to work into the early strategy, which is ERLI, education, retirement, life expenses, and insurance, that this could potentially be a great instrument. I would love your feedback on this. And as we work out the models to see how it compares to other investing strategies, what your thoughts are on that. Let's give this one a whirl and let's see if it's something that we can add into our overall investing strategy. All right, now we're going to go into the Q&A. Each time I go into one of these questions, I'm going to ask the question. I'm going to give my view or response to the question, and then I'm going to talk about how it flows into the early model or the Raising Millionaires course. Question number 1. Do you believe that after this course and maybe a little bit more digging, I'll be able to move from secure to high-risk investments? It's an interesting question. The person asking this, I'm wondering what they're thinking. This course is not designed to move you from a successful investment model into high-risk investments. Again, I'm trying to get myself into the head of the person asking this. Most people think that high-risk investments equal potential for higher reward. That, of course, is the case, but when you deal with probabilities, and we want to put it into the context of raising millionaires or developing those investment models that lead to our children's financial freedom, we don't really use high-risk investments in the course, primarily because they're not needed. What we're going to do is we're going to leverage the time that we have to reach those specific goals, coupled with compound interest, and then using instruments that have the highest rate of return over a given period of time, which is typically an S&P fund that has that 10 to 11% return annually over any 10-year period, so that we can reach our goals with the highest probability. Now, if you're looking to your individual portfolios and you have an appetite for risk, you can, of course, do that, but there's not really a place for it inside of the Raising Millionaires model or inside of early ERLI, which is investing for education, retirement, life expenses, and insurance. We want stability in those. So we're not going to really focus on high-risk investments inside of this program, but I do appreciate the question. Question number 2. What is the best way to create a financial plan and stick to it over time? This is a great question. When you think about creating a financial plan and you want to stick to it over time, I go back to setting SMART goals. SMART goals are defining the goal in detail. So from a financial perspective, it's how much money you need, why you need it, when you need it, and then using time and budgeting to figure out how much money you need to invest each month to reach that goal. And finally, what instrument are you going to put that money in? Now, let's talk about this in the context of Raising Millionaires. So Raising Millionaires uses the early process, ERLI, investing for education, for retirement, life expenses like buying your first car, getting married, going on a honeymoon, having an emergency fund, and then insurance, which is basically life insurance, which has its own models for it that we cover in the course. So let's set a goal. We have a newborn child. We know that they're going to go to college in 18 years. We know that the College Board, which does all the research to tell you what college is going to cost in the future, says that in 20 years, that college is going to cost $180,000 for a 4-year degree or $45,000 per year at a public school. So we know that in 18 years, we need $180,000. Now, we can do the math. That equates, when using an S&P fund, let me take that back. When using an S&P style fund inside of a 529 account so that we can get that tax-free growth when using the money for qualified expenses, we're going to need to invest $500 a month. Those models say that with a 10% return rate at $500 a month over 18 years, we're going to invest approximately $100,000 and we're going to have an output of $180,000 by the time we need that money. Now, there's a little bit of flexibility because you're not going to write that $180,000 check on year one. You're going to pay $45,000 in year one, then year two, then year three, then year four, and your underlying bucket of funds inside that 529 is going to continue to compound during that time so that it's going to help offset some of those additional costs that you might run into. That's how you create and stick to a financial plan. Now, in any expense, you need to do the exact same thing. How much do you need? When do you need it? Why do you need it? What's the budget going to be to get there? And then what instrument are you going to put it in? I say instrument because if you're planning for retirement, maybe it's a Roth IRA. If you're planning for education, it's a 529. If you're planning for some other type of expense, maybe it's a brokerage account, maybe it's bonds, depending on the rate that you can lock in. Taking all of those into account, you can build out a SMART goal. A SMART goal leads to a plan. A plan leads to success. Great question. I'd love to talk to you more about it in our Raising Millionaires community so that we can help you work out your SMART goals and help build out those models for you to reach financial success and to set your kids up for financial freedom. Next question. What are some common investment pitfalls that I should avoid? Let's talk about 3 big ones. The first one is investing when the market's hot and then either selling or not investing when the market's cold. This is a recipe for disaster. Really, what you want to be doing is you want to be doing dollar cost averaging. When you set SMART goals that are part of the Raising Millionaires early plan, which is investing for education, retirement, life expenses, and insurance, you'll find that dollar cost averaging, or the idea of setting a budget and investing the same amount of money every month continually and staying consistent, is going to give you the best results, because you're going to be able to buy more of whatever instrument you're buying when the market's down, but you're not going to ever get out of the market, so that you can get those long tail averages, like in the S&P has over a 10% return over any 10-year period, which will help you reach your financial goals with a greater probability. So rule number 1 is you want a dollar cost average. You don't want to get out of the market when it's cold and then jump back in when it's hot. The second investing pitfall is not setting goals. Without a goal, you don't have a destination. Without a destination being an amount of money in a specific time for a specific reason, you're not going to know how much to put in each month. You're also not going to know what instrument to use. There are different instruments that have different tax benefits and different returns, which will help you reach your goals more efficiently. Those can be 529 accounts. Those can be IRAs of some type. Those can be bonds. Those can be brokerage accounts. Knowing Your goal will help you find the right instrument to be able to put your money into the right place at the right time to get the right outcome. The third investing pitfall really is more of a modern problem, which is chasing. Chasing is the idea that you're on Twitter and everybody's talking about buying Bed Bath & Beyond because it's down to 29 cents. Well, surprise, the company just went into bankruptcy and you're not all your money. The shorts have made $1.4 billion in the last 24 hours, but retail investors were just completely wiped out that were in that stock. So you don't want to chase. You want to find good, stable, diversified instruments such as the S&P 500. And then you want to find the right type of accounts, and you want to continue to consistently contribute over time in order to help reach your goals. So those are the three investing pitfalls that I would like you to avoid. And those will help you to reach your financial goals over time. What is the best way to stay up to date on current investment trends and news? Now, this is a double-edged sword. You can follow social media, you can read threads on Reddit, you can read CNBC, you can read Investors Business Daily, you can read the Wall Street Journal. One thing that I might advise you, though, is that more information is not necessarily better information. I have found that the more people try to research their investments, the more that they actually make bad decisions on their investments. Inside of the Raising Millionaires strategy, we want to show you how to set goals, set budgets to reach those goals, choose the right instruments, and to help your children reach financial success by defining all of those elements and then setting up consistent investing to help you reach that. We're often going to use more, I don't want to call them stable, but over the long term, more predictable would be the right word, such as the S&P, such as bonds, so that you can outline how you're going to reach your goals. If you're watching investment news all the time, you might see something like, oh, this bank just dipped by 96%. Maybe I'm going to short it to see if it goes down even further. Or, oh, everybody's talking about Bed Bath & Beyond and I'm going to go buy that stock because it's at X dollars and then maybe somebody's going to buy it for this much more and I'm going to double or triple my money. Or you know what, I'm going to chase the latest cryptocurrency trend because that market's about to blow. That's not going to help you reach your goals. It's fun, don't get me wrong, but that's what happens when you're consistently watching the news. My wife doesn't even open her monthly portfolio statements from her retirement accounts. She's like, I'm dollar cost averaging, putting money in every 2 weeks, and I know what my goal is, I know what the instrument is, I know what the average return over time is, and I know what the outcome's going to be at a specific date and time in the future. That's it. That's the brilliance. So, to answer your question, I like to watch Bloomberg, I like to watch CNBC, and I do stay up to date on social media just to see what people are talking about, but I have learned over the last few years, now this wasn't always the case, don't chase, you don't win. Should I primarily invest in stocks, bonds, or real estate? What is the best diversification portfolio of all of these assets? There are two answers to this question. One has to do with the way that we do it in Raising Millionaires for our children. For our children, we're going to use the early model. We're going to invest for education, retirement, life expenses, and insurance. Typically, in those, we're going to use index funds, which are a bucket of stocks. We're going to use bonds, and then we're going to use the different types of insurance policies that aren't necessarily annuities, but they have a guaranteed rate of return that allow us to plan for future goals, such as having enough money to pay for our kids' education, knowing how much money our child's going to have at their retirement age of 65 or whatever that age may be in the future. When we look at us as parents, which is the second answer to this, you do want to have a diversified portfolio. Now, I'm going to talk about what I like to see in my portfolio from a diversification perspective. You're going to see stocks, you're going to see bonds, you're going to see investments in private companies, which have always performed really well for me. You're going to see investments in real estate. They're great for cash flow. And then you're going to see investments in more alternative types of items, such as early stage startups and cryptocurrencies. You have to decide what's right for you in your portfolio. Now, the question then is, how do you decide? Each one of your investments should be inside of a specific type of an account. That account should be designed to help you reach a specific goal. This is where a lot of investors fail. They're continually putting money in and buying things and trading in and out of, and they're trying to maximize profits today. Now, if you're a professional trader or investor, there's nothing wrong with that. The reality is, though, the 98% of you that aren't professional investors that try to invest using those types of strategies are probably going to get crushed. 98% are pulling out of the sky, but I'm going to say it's realistic, knowing the people that I've seen try to get into trading and how poorly they've done most of the time. So now I'm going to look at my IRA. Now it's got a couple different entry points to it because of my earnings in specific years and what I can do out of a company and what I've earned from other companies is working with them. That's my retirement. I know what my number is. I know what it's going to take to get there. I know how much I have to put in each month. So I want to pick the instruments that are most likely to help me get there. Real estate, I know how much cash flow I want to have in retirement. So my investment strategies in real estate are all geared towards that. As I get older, I've got to slow down those things, but I also have to make sure that I'm going to hit that magic number. My private company investing is still about finding best-in-class, cutting-edge technology companies that I think are going to revolutionize a market, and then buying. I have a specific number that I put into each of them. It's a small number, but it's worked well for me over time. I've been in cryptocurrency since 2013, so I've seen the ups and downs, and I know how to steadily invest into that and to ride out where I potentially think things are going to go, and that's part of my 2040 target date. Both my kids will already be through college. That's kind of like my magic age where all of these things need to line up. So what you need to do is don't think about whether or not I need stocks, bonds, or real estate. I want you to think about your goals. And then once you have your goals defined, then you can look at what instruments are going to help you get your goal. And then you're going to look at what investments inside of those instruments or those types of accounts are going to help you reach those goals. Happy to talk to you more about that. Just shoot me a message and we can figure out what works best for you. What is the role of inflation in investing? And does it have one? This is a fun question. When we look at investing as part of our Raising Millionaires program, and we look at the different expenses that we're investing for, so education, retirement, life expenses, and insurance, using the early model, ERLI, inflation does play a big role. If you are modeling out an average rate of return of about 10% per year inside of a fund in order to pay for college education, but inflation is at 9.6%, you're basically getting cannibalized completely, like 0.4% difference. That could dramatically change the outcome of your investing strategy. Does that mean that we change how we invest? Not necessarily. The early model is set up using long-term goals, budgets, time, and compound interest. The part of it that makes up for inflation is that every year we do an annual review. We look at all of our goals, we look at all of our accounts, and we look at all of our balances. We figure out where there might be a deficiency on what that balance is compared to where we should be based on our child's age. And then we look to try to do catch-up payments over the next year relative to the amount that you can put in each type of account based on the different rules, regulations, tax ramifications, so that we never fall too far behind. If every year you do these catch-up payments, you may have to put in a little bit more to compensate for inflation, but you're not going to miss your goals, which is the primary reason that we do it this way. So as long as you stick to the early model, ERLI, you use the account types that we use, brokerage, 529s, bonds, and specific types of insurance policies, in the annual review process, you're going to be absolutely fine. And this is stuff that we cover in the course, and then we stick with you till your kids are 18 years old, and we make sure that this is all modeled out for them so that you have the highest probability of success. What advice would you give to a parent in the course who has a kid that is closer to graduation than to middle school regarding investing and raising the next generation of millionaires? In the early model, we talk a lot about being early. So ERLI is our investing in education, retirement, life expenses, and insurance policies. The earlier you start, the easier it is to reach your goals. For example, If you start putting $50 a month away into a Roth IRA the day that your child is born, by the time they're 65, if you continue to invest that entire time, they'll have $6.5 million. If you wait until they're 10 years old and start that exact same model, they'll have $2.1 million. So you've lost $4 million in retirement savings from basically 500 times, 600 times, and $6,000. $6,000 cost you $4 million, right? Like, that's painful to hear. But the best that we can do is start today, right? We have to model out our goals, because we might budget for smaller dollar amounts based on the children being younger so that we can use time and compound interest to reach our goals. But that doesn't mean that we still can't help our children reach their goals. We just have to put more money in. Just the plain and simple truth. So if your child's 12 or 14, you might not be able to save as much money for their education based on your available budget, but you can save some. And every amount that you save is going to protect you, your retirement, your financial wherewithal, in order to help them reach financial freedom in their future. More importantly, you can still do life insurance and get it at a fraction of the cost of what it might cost a 30 or 40-year-old. You can still start putting in a ton of money into their Roth IRA. If you think about it, we talk about putting in $50 a month. That's $600 a year. You can put up to $6,500 a year into a Roth IRA, so 10 times what we use in our course. There's a great way to catch them up and to make sure that they're still going to have a lot of opportunity for financial freedom in the future. So don't feel that because you're starting later that you shouldn't start at all.